Assalamualaikum and hi everyone. Today our group will present about taxation on petroleum industry. My name is Muhammad Firdaus Binli. My metric numbers 256276. Okay, let's start. Concept and definition. What is the petroleum? According to Petroleum Income Tax Act 1967, Section 2, petroleum means any mineral soil or relative hydrocarbon and natural gas existing in its natural condition and casing head petroleum spirit, including bituminous shales and other stratified deposits from which oil can be extracted. It means that petroleum is crude oil and natural gas which is found under the surface of the earth. Okay, this is the petroleum industry structure. First, upstream. In upstream sector, included searching, drilling well, operating the well to discover the crude oil or raw natural gas. And then crude oil will be transferred to refinery. Refinery is the place where the crude oil will process into petroleum products such as gasoline, heating oil, fuel oil, and so on. After that, petroleum product will transfer to downstream sector, which is Caltech, Petronas, Shell, and so on. And then customer will buy it. Petroleum operation. Petroleum operation means searching for and obtain of petroleum in Malaysia by or on behalf of any person for his own account or on a joint account with any other person by any drilling, mining, extracting or other operation, and any sale or disposal by or on behalf of that person of petroleum obtained, but does not include first, any transportation of petroleum outside Malaysia, any process of refining of petroleum, any dealing with products so refined or service involving the supply and use of which the rich ocean taker and buggers. Petroleum operation also mean any sale or disposal by Petroleum Nasional Berhad within Malaysia of petroleum obtained from outside of Malaysia and included the transportation within Malaysia by or on behalf of Nasional Berhad or such petroleum to any point of sale or deliver within Malaysia. Charge of petroleum income tax. According to Petroleum Income Tax Act 1967, Section 3, petroleum income tax shall be charged for each year of assessment on the income of every chargeable person. It means that income derived by such as chargeable person from petroleum operation will be taxable. Okay, so who the chargeable person? Chargeable person in this case is first Petroleum Nasional Berhad, second Malaysian Thailand Joint Authority, and third in relation to each petroleum agreement, any other person carry out on petroleum operation thereunder.
My name is Zarin Arjuna binti Zain Abdi, metric number 255813. I will proceed to the second outline, which is tax rate. So for the year assessment 1983 and prior, the petroleum income tax rate is 45% for the year assessment 1994 to year assessment 1997. The tax rate is 40% for the year assessment 1998 and onwards. The tax rate is 38%. So now we use for the petroleum operation will be taxed on the chargeable income at the rate of 38%. However, Um, Income derived from the petroleum operation in joint development area will be charged as follows. For the first 8 years of production, it will be charged at 0%. The next 7 years, which is 8 to 15 years of petroleum operation, it will be charged at 10%. For the subsequent years of production, it will be charged at 20%. Next, we move to the third outline, which is basic period and taxable income. So under PITA 1967 imposed tax on petroleum operation, which is tax house briefly defined in section 2 of PITA in 1967. Income tax and petroleum income tax are mutually exclusive. Under section 84 of PITA 1967, expressly provides that income derived from petroleum operation and any dividend paid by any company out of its income derived from petroleum operation are not chargeable to income tax. So under section 5 subsection 1 of PITA 1967 stated that the accounting period ending on any day or in a year of assessment shall constitute the basis period for the year of assessment. So under section 5 subsection 2 of PITA 1967, accounting period in relation of chargeable person means a period of 12 months from commencing on the date of the first sale or disposal of chargeable petroleum, whichever is earlier, or such shorter period commencing as a port state and ending either on the date selected by that chargeable person with the approval of Director General or on the date when that chargeable person ceased to be engaged in petroleum operation, or each subsequent period of 12 months, which is more than 12 months during which that chargeable person is engaged in petroleum operation, or any period of less than 12 months cease to be engaged in petroleum operation or cease to derive income from its petroleum operation, whichever is the latter. So this is the format to calculate taxable income, which is net profit before tax at non-allowable expenses, and then less allowable expenses, and then you can get adjusted income. After you get adjusted income, you should minus balancing allowance, capital allowance, education allowance, and then you can get statutory income. So for the element of gross income under PITA 1967, the first one is sales of natural gas or casing head petroleum spirits, which is mentioned under section 7. The second one is sales or exported of crude oil based on market value, which is mentioned under section 8 and 9. The third one is chargeable petroleum delivered to refinery or gas processing plant, which is stated under section 10 of PITA 1967. The next one is reference to crude oil include reference casing head petroleum spirit which has been injected to crude oil under section 12, and the last one is miscellaneous receipt under section 13. So miscellaneous receipt is other receipt of revenue that arising from any petroleum operation other than activities in section 7, 8, 9, and 10. So for the example, receipt of revenue from petroleum operation insurance, indemnity, recruitment, recovery and reimbursement, and compensation for loss of petroleum operation.
Hello and Assalamualaikum to Dr. Saliza and to my fellow friends. My name is Fatin Noraina binti Armansyah and my metric number is 255529. And I will continue with my part, which is allowable expenses. Allowable expenses is under Section 33 of the Income Tax Act 1967, while for the petroleum, It is under Section 15 of the Petroleum Income Tax Act 1967. Allowable expenses is to deduct the person's gross income from that source for that period and must be wholly and exclusively incurred during that period, which is include first one is interest payable upon any money borrowed by the chargeable person in the production of the gross income. Secondly, rent payable that chargeable person such as land, building, or any part occupied by them. The third one is the expenses incurred for the repair of premises, plant, machinery, or fixtures. The next one is specific bad debts. The next one is a maximum of a 19% of EPF contribution. The next one is a provision amount of any equipment necessary to assist any disabled person employed from the business. Last one is the provision amount of services, public amenities, and contributions to a charity or community project which is approved by the minister. So for the number 8 and 9 are the only for petroleum operation but not included in the company tax. Number 8 is all eligible expenses whether it is productive or unproductive for drilling, exploration, appraisal, and development wells. And last one is the depletion allowance. This is the example of the deductions in respect of outgoing and expenses. This is what I took from the Income Tax Act 1967. Allowable expenses. It is the expenses that include in the subsection 39 of the Income Tax Act, which is disallowed as a deduction against gross income. Meanwhile, for petroleum, non-allowable expenses is under Section 18 under Petroleum Income Tax Act 1967. First one is disbursement or expenses not being money fully and exclusively laid out or expended. The second one is a capital withdrawn or sum employed as capital. The third one is pension, provident, savings, widows and orphans that is not an approved scheme. Fourth one is rent or cost of repairs premises that is not used for the petroleum operation purposes. The fifth one is the depreciation of any premises, buildings, structures, works of a permanent nature, plant, machinery, or fixtures. Okay, the sixth one is the domestic or private expenses. In addition, interest, royalties, services, technical advisors, assistant rent, or other payment. The next one is the amount of chargeable tax payable under this Act. The ninth one is the amount of the income tax or of any identical or substantially similar tax. The lastly is the 50% of expenses incurred in the entertainment. Okay, this is the deductions not allowed that I took from the Income Tax Act 1967. Other incentive, there are two, which is participation in approved carrier fare and double deduction. Participation in approved carrier fare is any person who participates in carrier fare held outside Malaysia that organised or endorsed by Talent Corporation Malaysia Berhad, which is a company limited by the Guarantee Incorporated under Companies Act 1965 and it is approved by the Minister. For double deduction, the first one is travelling cost, which is attending course or seminar. That daily allowance is restricted to 400 ringgit per person or the actual cost is incurred whichever is lower. The next one is rental. The next one is rental. such as buildings, motor vehicles, equipment, machinery that is directly. The third one is registration fees. The fourth one and the last one is the other expenses directly incurred for the registration of patents, trademarks, or product licensing such as stamp duty, legal fees, and consultancy fees. And that's all from me. Thank you.
So I will be explaining on the capital allowance. So capital allowance is change over the fixed asset used in the productions of the petroleum. Under the capital allowance, QEE is incurred during the explorations and development period and accumulated and carried forward until the first sale of petroleum. According to the second schedule of PETA, qualifying expenditure is qualifying plan or qualifying building expenditure. The initial and annual allowance are given at different rates to the exploration activity, asset used for drilling, and industry building for exploration. So firstly, qualifying plan expenditure is an expenditure that incurred by a chargeable person on the provisions of plant and machinery that used for the purpose of petroleum operations that includes three items. So firstly, expenditure that incurred by the chargeable persons on the alterations of an existing building for the purpose of installing plant and machinery and other incidental expenses incurred on the installations. Secondly, the expenditure that incur in preparing, cutting, tunneling, or leveling the land to prepare a site for the installation of plant and machinery. The expenditure does not exceed 10% of the aggregate of such cost and the cost of plant and machinery. Lastly, it is also include the expenditure incurred on the provisions or constructions of fixed offshore platform for drilling, productions or other petroleum operations. Secondly, the qualifying building expenditure. It is a capital expenditure incurred by a chargeable person on the constructions or purchase of building which is used at any time after its construction or purchase. And lastly is the qualifying expenditure for the non-commercial vehicle. It is restricted to 100,000 provided that the cost of such vehicle does not exceed 150,000. Otherwise, the amount of qualifying expenditure is restricted to 50,000. The second last part is the initial and annual allowance. So under initial and annual allowance, there were two, which is a qualifying plan or the building expenditure that have different rates of capital allowance. So this is for the qualifying plan expenditure of the initials and annual allowance. It have secondary recovery, any other case, fixed offshore platform, environmental protection equipment and facilities, and lastly is computer software and hardware. So this is under the building, the secondary recovery and any other cases. So the last part of capital allowance is the balancing allowance and balancing charge. So balancing allowance and balancing charge is a rise on the disposal of the asset. So balancing allowance is when disposal price is less than the residual expenditure, while the balancing charge is when the disposal price is more than the residual expenditure.
Assalamualaikum and good morning to all lecturer and fellow friends. My name is Muhammad Yazid bin Yusuf, entry card 255947. Okay, let's move to the next part, which is appeals by the chargeable person. Appeals occur when the taxpayer is dissatisfied with the tax assessment that has been made by the tax authority. Appeals has been more justified more on the Petroleum Income Tax (PITA) from Section 42 to Section 47. Based on Section 42, it's emphasized for the purpose of this Act, there shall be 3 or more Special Commissioner of Petroleum Income Tax and Secretary to the Special Commissioner. The Special Commissioner and the Secretary is the person which has been elected under the law related to the income tax and shall be Special Commissioner and Secretary for the Petroleum Income Tax. Section 43, which is right of appeal. When the person or the chargeable person receives the notice of assessment, he may be dissatisfied with the assessment that has been made. The person are eligible to file an appeal to the Special Commissioner by writing to the Director General within 30 days from the date of assessment has been made while stating the reason of the objection. The chargeable person may elect the agent for the tax assessment, and the chargeable person and the agent shall be dealt together with the same objection. This section is emphasized. This is the form that the chargeable person need to be used in order to apply for the appeal due to dissatisfaction of the assessment. These forms are available and need to be downloaded in the IRBM website. Move to the section 44. Section 44 emphasizes on extension time of an appeal by writing a notice to the Director General within 7 years after the end of that period that has been emphasized on Section 43. Upon receiving the written application, there were 2 circumstances that may arise whether DG satisfied with this application or DG dissatisfied with the application. If he satisfied, he will write a notice whereby the extension. However, if he dissatisfied, he will forward the application to the Secretary. Form N is form that has been used by the chargeable person that wish to make an extension of appeal that has been emphasized on Section 43. The Form N is available in IRBM website and need to be downloaded. Let's move on to Section 45. Section 45 is emphasized on review of Director General as a result of appeal that has been made by the chargeable person. On the receipt of notice of appeal under Section 43, DG shall review the assessment that related to the appeal that has been made within 12 months. After making the review, there were several circumstances that may arise by Director General, which is come to agreement in writing regarding to the tax payable with the chargeable person, come to oral agreement with the chargeable person and follow up with written confirmation, deem agreement in writing if that's not reputed within 20 days, serve the proposal and chargeable person may accept or reject. Failure to do so is deemed accept as agreement in writing. Let's move on to section 46, which is disposal of appeal. This section emphasizes in situation whereby the Director General may fail to make an agreement with the chargeable person. Director General will forward the case to Special Commissioner and a written notice will be served to inform the chargeable person within the 12-month period from the date of receipt of notice of appeal. That's all from me. Thank you.